Trillions of dollars are at stake and quadruple witching is coming. Hello, ladies and gentlemen, and welcome back. It is a massive options expiration we're about to see with the OPEX this month on the third week expiration. We know volumes are up, markets are rallying, and smart money is doing something very different to what dumb money is doing. So is this the beginning of a new rally for the S&P 500? We're about to hit critical on stocks, commodities, and cryptos. Let's take a look at all the key levels right now together. Well, welcome back everybody to the Daily Show. Let's talk about the big thing though. Trillions of dollars or options contracts are expiring. Yes, it's quad witching, and that means that all of the single stock futures, index futures, etc. are expiring on one day. And it's a big one. It's usually a blockbuster in terms of volume. And as we mentioned, the Thursday tends to be volatile, which it was, big rallies. And the Friday can be also very volatile. We'll be talking about the maximum pain levels and whether Wall Street's doing an amazing job to get it to that level just before expiration. Turns out so far they have been. Smart money versus dumb money. We shared this over on our Twitter at FX Evolution if you're interested in following. And you can see here that especially recently, smart money has been purchasing these lows. Could this mark the bottom for the markets? Well, yeah, it's certainly a big deal that smart money's been going so hard into this. I believe it's because basically the central bankers have come out and said, hey, we'll support these banks with liquidity. It's kind of like a cash injection, and that tends to lead into maybe a Fed pivot. Now, we don't know that yet. Do remember to watch this show, subscribe if you're interested in our channel, because we will be following the Fed pivot story. Depending on what Jerome Powell says in the upcoming meetings and the Fed does, the market may actually crack a tantrum and cause further sell-offs. But I want to focus on one of the biggest sectors. The hottest sector of 2021 into 2022 now looks almost toxic. This is the energy sector, and it's a surge in 3-month lows. I'm about to present why I believe energy is going to have a mixture kangaroo, if not down market, over the next 6 months. So the first thing here is the percentage of S&P 500 energy stocks closing at a 3-month low, 75% plus. We only see this 0.37% of the time, and it tends to lead to an annualized return of negative 46.6%. That's not very good. If we also have a look at the new sectors and consider the ones that are going to new bull markets or new bear markets, there's a big difference here. Energy sectors, 78.26% are closing at 3-month lows, 51 on financials, 38.71 real estate. Notice the difference here. Communication services, technology, and one of my favorites at the moment, utilities, are all completely different. They're on the other side of the scale. So no wonder the NASDAQ is absolutely outperforming the S&P 500 right now. You have many 6 sectors of the old economy over here, and you have a lot of new economy and dividend style plays, defensive plays doing well on the other side. It's a weird world we live in where the Federal Reserve is coming out playing an acting game saying, hey, we're going to support these deposits and the financial stability of the system, but at the same time, we're considering the concept of burning the economy, and we've probably broken something. So what about S&P 500 energy sector returns when we see these readings? Well, the good news is we have a lot of data reads from this. When we tend to get these reads 12 months later, it's very mixed. And whenever you have like only a 57% market, notice that 2 months later, you're tending to lead into the bearish side of that particular sector for a period of time, the kangaroo style market. We also know there's been a deterioration in participation. Basically, no one's buying these things anymore. The breadth composite has gone well low. It's actually returned all the way back down to an extreme low. We've only seen this 8% of the time in statistical figures, and it tends to lead into an annualized return of negative 19.6%. So another bad reading here for the energy sector. And again, S&P 500 energy after the breadth, as you can see where we're at, maybe it's a little too expensive. And again, the stats are not pointing towards the good side. So what it shows you is that it's great to ride the rallies. It's great to hold into the concepts, but the market definitely doesn't believe we're in an inflationary boom anymore. And it may not even believe we're in stagflation anymore, at least according to that. Commodities tend to do really well during stagflation, and they tend to do very well during inflationary booms. So inflationary boom's certainly over. Will we be in stagflation or a crash? That we don't know just yet. But these are some sectors or some rotational switches that are occurring in the back end. Let's talk about target rates. We know that the Federal Reserve is expected now. Remember, 1 week ago, they expected 50 basis point hike, 86% of economists. Now they expect that basically we get no hike and they're going to stand and pivot. If they don't pivot and the Federal Reserve sticks to their words, which is we'll do whatever it takes to stop inflation, which remember is still hot and sticky, the market may crack it. If it does crack it, of course, the bears will take control. So this is one of the most pivotal times for the Federal Reserve, probably in the last couple of years. And I believe one of the most pivotal times to see the market fight with the Fed about price. Do you think that they'll crack it? Let's have a find out. Let's see whether you believe the Federal Reserve will stick to their word and fight inflation, or whether they're going to say, no, okay, we're pivoting, we're not going to go any higher, and we'll wait and see. Well, it's going to be a very interesting one. So we know that the Fed usually acts slowly, and we also know they break something. They're probably broken something. And clearly, they've broken the financial system. There's probably worse things behind that we don't know about. And they're going to continuously come in, just like the Swiss National Bank did with, or the Swiss government did with Credit Suisse. We have to expect that every single banking disaster will be plugged because they broke the monetary system. They're going to have to do this. Now, if the market had toxic debt in it, and I mean really toxic debt, of course they wouldn't be able to hold it. But at this stage, we have to believe that every single one of these holes will be plugged, just like the Euro crisis of 2022, when we saw the pension funds in the UK go under scrutiny. All of a sudden, the central bank's out. We're going to support it. Don't worry about this. You must kind of consider that that is a thing. And the only time that the Federal Reserve and other central banks won't be able to hold it is toxic property debt. If that goes bad, I'm telling you in the future, Great Depression's coming. Let's go hide under the desk and we'll see you in 18 months. Of course, we'll create the Daily Show, but you know what I'm saying. So US equities are following, of course, still the no recession path. They're not on a new low yet, and we're about here at the time of this recording. We're now probably about there, actually. So if we continue down the no recession path, we expect it to make new highs. I believe that the bonds market has told us we will go into recession, and it does seem like the US will go into recession sometime late 23, if not 24. If that happens, there's still a chance for a new low to be formed, even though for now we could be going bullish. You've kind of got to hedge your bets, though, both ways, because these central bankers are very, very nasty. Let's have a look at another thing. We know EPS growth went down and it went to a negative reading. That often creates something like here, 2015-16, where we see kangaroo-style markets that are trading at some extreme zones. Previous times that we've seen EPS go negative, the earnings results have been shocking moving forward. And when that happens, we get a price reduction. We basically see a huge amount of price reduction. And if we get a recession, we also see equity risk go up as well. So this is equity risk price. We basically see this become very, very big difference. Now, Morgan Stanley's Mike Wilson said this. I truly believe it. If we get a recession, you will see basically people consider, well, what a treasury is giving me, what a stock giving me. I might want to take treasuries because the risk is too great in stock. So this becomes something that tends to expand during recessions, and it's certainly worthwhile keeping it in the back of your mind. If you haven't viewed the channel before as well, you may not see this before. When the Fed pivots, it's not usually out of the goodness of their heart. It means they broke something. And if they do pivot, a few months later, we tend to see something bad coming through. And I'm not saying it's a 50% crash, but certainly further weakness and a new low would be in line with other data points we've seen before. But we don't know that yet, so we have to go with the trends at this stage. So over the last 5 days, we've had a lot of rotation. My little utilities has been holding as best it can, and it's certainly been running, but technology and communications just overtook it in the last 24 hours. It had a better day. Yeah, I know. But still, you can see here the defensive sectors overall over the last couple of days, technology and communications have been the best runs. In the last 24 hours, though, it was all about technology and communications. You can also see a bit of reprieve in some of the big banks, with them rolling up. So basically the big sectors here have been anything that benefits kind of from, some people would say lowering rates, but my belief is it was actually economic stimulus. See, when you go and you backstop these banks, you're kind of doing some kind of central bank quantitative easing to a degree, providing that liquidity that tends to ride into assets through the financial stability of the system. So I think we can all agree that recently the markets have been dictated by news, Credit Suisse, Silicon Valley Bank, and of course, central bank monetary policy. These are the big stories that are going around. Well, the great news is the sponsor of today's video, which is Tiger Brokers, has just upgraded their platform and they're adding more information quicker in a better format. Whether it's the application on your phone or it's the desktop version that I've got here, both have been updated. One of my favorite features has to be this auto refreshing news feature. Every 1 minute, it'll auto refresh and give you the latest information to do with premium news feeds and things that are coming out. No more having to refresh all of those websites out there. That's super annoying. I also love when we have earnings calendar reports. Over here, you can select daily view, weekly view, and monthly view, but more importantly, select the dividends, IPOs, or report announcements that matter to you. You can set it up as a watch list just so it shows the ones that you care about in your watch list, or you can set it to the country of your choosing. In this case, of course, we select the US. So I love having the weekly, the monthly, and all of these excellent views putting through. And if you're interested in Tiger Brokers, you know what? It doesn't just stop there. It gets better. They're offering some extra special offers in the description down below. Now, I've suggested to them that maybe they might want to give away a little bit of Tesla stock. The good news for any of the viewers out there that are from Australia, and I believe potentially from New Zealand, you'll be eligible for an extra US $30 of Tesla if you open an account and fund it with as little as 1 cent. So let's now jump into the charts and have a look at all of the hottest levels right now. We'll look up here with the VIX. The VIX hit 30 a few times over the last week. It hasn't hit that 45 magical number. I'd like to see a 40 plus VIX to really show us a lows in. We haven't really seen fear all of 22 and even so far in 2023. In the past, having Credit Suisse needing to be bailed and having everything else needing to be bailed, like Silicon Valley Bank, would have already sent this VIX up to 60. But because we live in a time of weird central bank policy, they just don't freak the market out enough. It's very hard for the market to go down. Remember, it is easier to be a bull than a bear in markets almost all the time. You've just got to remember that. Being bearish is difficult, being bullish is easy. And remaining optimistic is generally the key, unless you have toxic property debt, and then you should ride under the table. As I said, you've got to be scared at that point. Let's move over here to KRE. This is the regional banks. So you can see they had some reprieve in the last 24 hours. This is a 2-week chart. There's a weekly chart. And if we go to a daily, you can see it's starting to form some kind of base potentially, okay? Potentially. So it's just basically holding before the next bit of information comes out and potentially a crisis or who knows what's going to happen. Let's look at yields. Yields increased a little bit here. So we actually saw a stabilization in yields after freaking out about Credit Suisse the day before. This is pretty much in line. We've had now a high, low, higher, high. And it looks like at this stage, even though we might see yields go back up here a little bit, it probably topped out. And that's because the Federal Reserve is most likely either going to only raise by 25 basis points or they're going to hold pat and pivot sometime soon. Remember, pivot doesn't mean good. So if markets theoretically go really, really bullish and super FOMO, it could be kangaroo style where all of a sudden a few weeks later, we're falling off going back down. It's timing is everything in these markets. Whether you're looking at the US 2-year or you're looking at the 10-year, it's all basically the same story. I think the biggest thing here, though, is we're still pricing in a rate cut by the end of the year. So that's changed a little bit. We were sitting at 3.5%. I mean, that's an extremely pessimistic view. That was expecting the Federal Reserve to cut a lot. I thought it was an overreaction, and now we're sitting back at 4.37. So I probably expect this to come back to about 4.5, and ideally, no rate cuts this year would be the generalized form, maybe one in December, but they were expecting 2 to 3 rate cuts, the market, only a few days ago. That's way too much. So this had a pressure on TLT. It means that TLT goes down. Why? Because yields went back up over the last couple of periods. I still think TLT is a very interesting zone, and I still am bullish on it over the medium to longer term. But of course, it's not really a trading pair. So I tend not to trade this. I tend more to look at it as an investment, or maybe you would call it like a multi-month swing opportunity. What about the markets? Well, they've come in and they've said, you know what, high growth is now good again because the central banks have said it's okay to take on risk. So you saw here high growth junk kind of bonds doing okay over the last 24 hours. In fact, they did one of the best. And I think that's just a reflection of central bankers kind of being able to say, well, don't worry about your zombie companies. We'll support them. And people saying, well, maybe it's worthwhile taking the risk since the central bankers aren't allowing anything to really fail overall. So, yep, another good green sign for the markets. Again, if this starts to turn negative, it's a warning sign to say, wait a second, we need to be very, very, very careful here. But high growth is up. Let's move over to the US dollar, and the US dollar didn't quite come back up yet. We're stuck in the middle of nowhere for the US dollar, in my opinion. I like it down here as buys. I like it up here as potential sells. And here I would call it neutral. I don't really have too much opinion on the DXY at this point, other than to say it did change trend towards the bullish side. And if it does pull back to this area, I expect some kind of buyers. It's around that 103.65 area. Let's move over to gold. It does well with lots and lots of yield cuts. It's repriced itself pretty quickly. Don't really have too much opinions on gold here either. I do think that it does okay over the coming months, since we've now seen a shift that could turn into a Fed pivot. But I think it might be volatile into the Federal Reserve's meetings. And that's because if the market doesn't get what it wants and the Fed says we're not pivoting, we're going to go 25 basis points and we will do whatever it takes, I feel like the market's going to crack it. So we'll find out. And then if the market cracks it and starts pushing yields back up, then all of a sudden you're going to see gold coming back down. I feel like it's at a fair value at this point, and you can kind of tell that based on this candle here, which is a long leg doji. So again, gold, pretty boring, I think, for the next 24 hours. Inside day, mostly just trading the range ahead of the options expiration. What about copper? Well, copper fell through. I still think copper falls further to 3.7. Copper falling through is a big deal. If the weekly does end up holding down, I've been on the record saying that I believe copper has been weak for some time. If it keeps going down, what do I think that means? I think it means a weak economy moving forward, potentially bad earnings coming up, and maybe the need for central bankers to stimulate weakness. So again, it could be deflationary. You have to look at this as, not good times coming ahead for the economies, and copper is a big reading. Dr. Copper, they call it that for a reason, and it broke through. Shows that the world is not too good at the moment. Natural gas, what's going on? Hit the zone. This is the 246 floating around in the middle of it. I'm not too interested in natural gas at the moment. Obviously, if you're an investor or trader, you like this level a lot. But overall, I want to see more on this one. So we'll keep coming back to it. Volume's dropping off. Interest is obviously starting to slow down as the crazy moves start to slow a little bit. What about US oil? Well, US oil put pressure back on that 66 again. Wasn't able to break to a new low. And I believe US oil is most likely negative for a while now, as in we move down into these areas. And that's kind of inevitable, but we could still do that before it does occur. Do I like what happened over the last 2 days, 2 sessions? Well, you've got to like the fact that it came down here. I would have liked it went a little lower, taking out people's stop losses down below here. But that's a nice looking candle. You could see some resurgence of buyers. 72s where I believe, between 72 and 73.20 is where I think sellers would recommence back into oil. But it's in our red box. In here, we're looking for accumulation. I doubt we've seen the low of oil just yet, though. I think it'll keep flowing down as we did in our study in today's show. We had a look at that overall. What about Tesla? Well, Tesla moves back up. Now, you're going to find that a lot of stocks are facing resistance zones, facing key levels where if the market breaks through these areas, we could see further rallies. But if it doesn't, we're going to probably see a market pull back over the next couple of days. So first one is look at these expected weekly options highs. We're very close to that for Tesla. So what if the market opens a little bit bullish? Could it sell off? Well, it's going to make sense with the options that we look at. So let's refresh here together the 3rd week options expirations. These are the 17ths. And have a look at the call buyers and the sell buyers. So maximum pain sits at 180. Current price is higher than that at basically 184. We know that there's a lot of 180 calls, a lot of 190 calls, and a lot of 200 calls. Too bad, so sad, 200 calls. You're going to most likely lose on this trade, but it just shows you why you don't really want to be on these crowded trade options. Where you do want to be, however, is sitting in this zone, because of course this is most likely where the markets would expire. Between that kind of 170, 180 range is the more likely options expiration come Friday. Could we rally a little bit and then sell off? Well, the technicals said that that's very possible. If we have a look over here, 186, nice previous support, nice options expected high. Anywhere in here is where you're kind of looking for that market to tip around. Now, I've talked a lot about the idea that Tesla could move down into this gap fill. I still think that's very possible. It just needs the market to actually start to find some weakness around here. We'll talk about that soon. Let's look at Apple. Apple is coming up to a massive zone, big supply, huge amount of rejections, huge level. I said, watch the reaction at 157.48. Can we reach that in the next 24 hours? Open up bullish and potentially see some sell-offs. It's been a decent run for Apple. Big, strong 24 hours, obviously 1.87%. A lot of people would like that. But this one was doing pretty well. It wasn't really the story of these stocks, though. It was more the story of things like Google, Amazon putting on 4, Microsoft doing 4, Nvidia doing a lot. But look at Nvidia also approaching critical resistance. This is a gap fill that happens over here. We've got 259 critical level coming up, and it's kind of in line with everything else. You know, if we move up a little bit through the session, so let's just quickly grab that refresh number, 1.49%, not very much. What happens at these points? We've got Apple probably breaking a new high. Could we see the trap set? Well, I think it will make sense when we look at the index in a moment. Let's have a look at the ASX 200. I've been negative on this pair for a while. This is the Australian market. The reason why is it holds 3 of the sectors that don't do well at the moment: financials, energy, materials. They're all not doing so well, and that's why the ASX is coming under some fire. I don't expect outperformance from the ASX for the next 6 months. Look, you wouldn't even think there was a recession or even any talk of it. It's been holding amazingly well. The problem is now where we sit and, of course, where we might go down to. It's still possible to go to 6,400. We're currently at what I would call a key level of support. The markets have to turn here if they're going to. But yeah, weekly close will be important for this one. We'll move over to that for our weekend show, and we'll look at a bit more deep dive for the Australian audience out there. Let's have a look at energy. So energy's been weakening for quite some time. It really fell through as of this day over here, which is the 13th of March. I do expect some bounce on this, but overall weakness back down into these 68 levels and possibly even lower. Remember, the annualized return for energy stocks after we saw those readings was really bad. It was like 20% kind of plus. So that would push you back into some of these zones over the next 3 to 6 months. And I don't really feel very strong about energy at this point. I think this is certainly a level that people can look at and maybe set alerts for in the future, but it's most likely on its way there. It just, again, depends on how it's going to get there. And will it be slow? Will it be fast? Probably a little bit slow and up and down and all around. Utilities continued its pretty good run, 0.67% up. I'd like to see utilities find another strong day of purchasing. You can see a very nice close on the daily here. It's broken through the downward trend. We've got a nice switch of trend as well that's coming through. I'd like to see utilities basically hold for the next month and find some nice, strong buying. That's what we're really looking for here. What about the DAX? Still think this market's not exceptionally good. It has a lot of banks. It has a lot of old economy style stocks. It fell through, and then we got this kind of tweezer low, which is promising. But I do expect the FTSE, the ASX in particular, the DAX and the France 40 to maybe underperform the US market moving forward. So yeah, look for the old economy stocks to do underperformance versus tech, I believe, in this new regime that we've just seen since Silicon Valley Bank and Credit Suisse. Downward trend line as well being reached here just earlier. So again, another market at its resistance. Now let's go to the big ones though, because this is where we talk about the big market, which is, of course, the US one. First up, we have the Russell 2000. Did it put a nice low in? Oh, it looked nasty coming into the open, but look, it continues to hold this level. As I said, if we get underneath here, watch out, yeah? If the Russell 2000 weakens underneath a key level, and it does it without the S&P 500, often it will lead the S&P and bad things tend to occur. This is the 2000 small companies. If they're sick, bad things happen. But we've continuously held this closure low. So I think the key is going to be the closure low. If we manage to get underneath, what is this, 1743 and close over the next 24 hours or even next week, I think that could postpone or that could start to create the real bear case here in the markets. Let's now look at the US 100, very strong market. I reported this thing was bullish, though I always use the S&P 500, but it was bullish the other day. And it just rally, coming up to some key critical zones again, previous supplies. It's had a nice run on it, possibly too much. We'll use the S&P 500 as usual to figure out whether we think it's moved too far. Here's the monthly on the Qs. You can see it's going close to that unfilled gap, which is 309.19, which I've got on here on the charts. And yeah, super bullish. I mean, it's absolutely destroying this very big weakness. But as we've seen before, this has happened before, where we have these big candles and they come through and then there's still weakness here in the Qs. Use the S&P 500 whenever possible to do your analysis on the NASDAQ. It does help out. Expected weekly options highs, we're approaching those now on the SPY. You can see we're getting there, 398. Pretty important zone. We'll talk about it very, very soon. Nice big daily close here on the S&P. Strong daily close. Strong daily close. So it points to most likely there being a little bit more rally to come through. And this brings up the biggest important level, the 61.8 of the high-low swing. And as I've said here, a very important zone. This is a very well-traded zone. And I think testing from the bottom up, if Wall Street's going to play the bear game, they'll want to do it in the golden pocket here. Somewhere within this golden pocket upwards of that last swing high, there should be bears. And those bears should be able to push down back into this range, which we'll talk about soon. Daily 200's been smashed. A lot of people will say that's a bullish indicator. Yeah, I mean, it's definitely a big deal that it broke through it. But to me, it's more that you broke this supply structure. So if we have a look here, this supply structure was absolutely nailed. We filled the gap from the bottom up. Excellent trading for anyone that bought that in the pre-market session. Well done to you. That gap's gone. So congrats. And now we go to this area here, a drop, a base, and a drop. That is supply. So because we know it's supply, we know that when we tap that level, which I also think 39.80 is key, when we tap that level, we hit a 61.8. We've got a lot of confluence saying that the bears could be floating around here. And it may also make sense to maximum pain, which we look at very, very soon. Pushing a high rhetoric, getting through, freaking everyone else out that they have to buy above the daily 200 and then crashing it back down, back into these lows. So I like the idea that that's kind of where we're looking at this stage. I think this is the key level. I think this will be a key level for bulls since we actually broke out and we made a lower low over here and a higher high now. So I think there's going to be a lot of buyers through this mid 38.80 range. But yeah, bears should theoretically be somewhere up here. Let's see what the options tells us. I'm going to refresh that for you all now. Maximum pain, trillions of dollars at stake, and it's a big, big one. Let's have a look here. 17th, 5.047 million units on the SPY alone. Where do we have the maximum pain? 396. Where's the current price? 396. So the market's doing a pretty good job, but it probably won't want to push above 400 because you can see there's a lot of calls, and it may not want to go below 390 over the next 24 hours. I think either we do see a high, then we see ideally a sell-off, and then maybe that continues through to the Monday session. It could also be volatile on the Friday, but it's done an amazing job getting back to exactly where it wants to be ahead of options expiration. So we'll go back to this chart for a second. The key thing that I'm thinking is the market makes a new high, kind of comes down, forming a base here, which is kind of nice, breaks that base, and then moves down to here, and then ideally I'd see buyers there. So they're the two main scenarios that I'm looking at the moment. Hopefully some critical levels that you can look at. We turned out that we were correct on this major confluence zone. And yeah, the markets loved that area. We had 3 main ones. Again, that's what you're doing as a trader. Remember, you have patience to react to what the market's telling you at certain zones. And that was the go ahead for the bulls. It was a massive bull buy. And yeah, it pretty much pushed to the areas that we expect. Probably still like to see 39.80 though achieved by this market. Let's move over to Bitcoin. It is floundering at the watch reaction here level that we've had for a long time now. Don't know what to say about it. We haven't really closed above. So we close above 30K. We sit around here, still theoretically where the bears hold it. So yeah, I'm looking for the bears to push back to below 23,778 and then that to force through sells. But at this stage, it's really about the daily close on Bitcoin and the weekly close. If it manages to break 25.2, which we know is a huge deal, it's never done it, then where do we move to? Most likely up here. 30K seems like a pretty good level to me. Let's move over to the calendar. We've got prelim UOM consumer sentiment, which could push the markets a little bit. And then as we know, moving into the next week, we start to come through with some extra information. We've got the FOMC statement and the Fed funds rate. What a big piece of information. This is going to be so important for, I believe, swing traders out there, investors and everybody else. Central banks around the world coming out to talk about everything that they have to do with. This is what the market is. I've seen liquidity over the last week spike pretty heavily back into the market. I mentioned that it was starting to come through. It's continuing to come through. If it continues again, yeah, the markets may actually bull higher. I know that might not be cool what you're looking at, but if central bank liquidity continues to come in the way it is, then you can't really fight them. You have to go with the trend, with the price action, and follow those technicals. We've got our short-term plan, and we'll find out coming this whether the liquidity plan is in as well. If you haven't already, come and follow us over at FX Evolution. Do remember we've got a March giveaway as well, which you can find in the links down below. And yeah, if you're also interested, remember the sponsor of today's video, which is Tiger Brokers. And if you're interested in any of their special offers, they're in the links as well. Thanks so much for watching. Subscribe, smash the like button. We'll see you in the next video. Bye for now.